Hello, thanks for joining us today on another Center for Agricultural Profitability webinar from the University of Nebraska-Lincoln. I'm Ryan Evans. I'm the Communication Specialist with the Center for Agricultural Profitability. And today is part of our webinar series that typically runs at this time every Thursday, noon Central. And you can always find an updated schedule as well as recordings of past webinars on our center's website at CAP. That's cap.unl.edu/webinars. Today is the first in a two-part series on the basics of livestock insurance, and these webinars are designed to help producers better evaluate their options. Part 2 will take place next Thursday, May 29th at noon Central Time, and we invite you to register for that on that website I just gave you at cap.unl.edu/webinars, and I will drop the registration link in the chat at some point too today. So today we're going to be talking about the fundamentals of livestock insurance, and understanding those is essential to managing risk in today's agricultural environment. We'll explore what livestock insurance is, how it can benefit your operation, and the different types of coverage that are available, all while defining key terms that can help you build a strong foundation for future decisions. And this presentation was put together by Shannon Sand, an extension educator and agricultural economist with the Center for Ag Profitability, as well as Matt Stockton, professor and agricultural economist. And they both are located in North Platte at the West Central Research Extension and Education Center. And Shannon was due to present today, but she could not be here. So we are in the capable hands of Matt Stockton, and we definitely want to answer any questions that you have, so please type those into the Q&A panel in your Zoom window as they come up, and we'll have time to address them at the end of the presentation. So I will turn it over to Matt Stockton. Matt, thanks for doing this.
Thank you, Ryan. Shannon just had an illness, and so she couldn't be here, and she regrets it, and she gives you your best for whatever that's worth. This presentation is part one. When Ryan was talking about it, one of the things it's about is, conceptually, insurances are made for different reasons. And livestock insurance, we're going to talk about 4 different types today, have a different purpose for different producers and are designed for, to basically insure different types of risk. And that's basically the concept. So we're going to talk about that in a conceptual way. And then the hope is that once we talk about that, we're going to talk about some scenarios and some other things next time about how they might work. So the actual functioning of them. So we're not going to really get into the nitty-gritty today. We're going to get into the conceptual idea. Okay, so this insurance does what, and what's it about, and why would I even think about it, and that sort of thing. And of course, I'm sure most of you already know all about this stuff, but sometimes it's good to review and think about it and make sure that, hey, if I do face these risks, this would be a good way to go. Or if we're having a certain type of year, or you think that there's going to be a drought, or whatever you're thinking about the markets and about that, and you feel like you have some risk, these insurances are basically designed to do that. So is livestock insurance for me? It's very simple. It may not be for you every year. It may be, and maybe sometimes a consecutive enrollment also has some advantages, especially for certain types of insurances. And we'll talk a little bit about that as we get later into the slides. So here we go. Livestock insurance is it for me? And of course, this is the research and the information, and what the thing we're trying to do is funded. And this is the funding information from NEFA. Okay, so obviously there's Shannon's information, there's my information. If you ever have a question, you can definitely contact us. And if we don't know, which there's a lot of things we probably don't know, we'll be glad to find somebody that does know and see what we can do to help you out. Because everybody has questions and everybody should have answers if they can find them. And it's not always easy to find them. Okay, so there we go. Moving on. Okay, so risk, the risk are challenges that you face. I mean, that's the whole point of insurance, is at risk. Risk is what it's about. Why is it important to mitigate it? Well, some risks are so bad that they can cause you financial hardship, or they can take your operation away from you. They can cause your families hard times. There's a lot of simple things that happen because of risk. And the idea of insurance is, if it needs to be affordable, of course, is to cover some of that risk and make sure that it doesn't put you out of business, doesn't create so much trouble in your life that is earned. And this is why the RMA has gotten into it, and the federal government has decided it's important. It used to be in the old days, what they would do is they would have commodity programs and try to keep prices and support prices and do those sorts of things. But in today's world, they've basically went off and said, okay, no, we're not going to do that. We're not going to support world prices. We're not going to have all this problems. And we're going to try and help producers if they want to mitigate risk to be able to subsidize crop insurance. And so when we talk about federal crop insurance and crop insurance programs, these programs are subsidized. That means the federal government says, okay, we'll pay part of it with taxpayer funds, and the rest of it you can bear. So that it's trying to make it more affordable, more usable for you to be able to use it. That's the whole idea. This is an interesting picture. It's kind of cool. But anyway, common risks you face, and you guys all know what you face. But here's the deal. Sometimes you could, one thing I noticed when I was first in ag economics was learning about cash flow. And I said, well, what's cash flow? Well, that basically, it's when you get cash, when you don't get cash. In other words, yeah, I got cash flowing in, I got cash flowing out. So when you have a cash flow, you could actually have a situation. I remember where I was working in the construction industry at the time. I was very young. My dad was about to retire, and my brother and I were taking over the business, and he needed a large sum of cash that he removed from the business. And if he removed all of that money, we wouldn't have had any money to actually stay in business. So while we had plenty of contracts and things on the books, we had to pay people salaries. And so cash flow can be very important as far as keeping you in business, because, oh yeah, you got a bunch of cattle out there, but you have no money to feed them, or you have, so the flow of cash is really critical. And that can be one of the risks that you face as a producer. In fact, in agriculture, it's a big risk. And that's why there's things like operation loans and that. But if they have a bad year, like you had borrowed money and then you have a drought and all that kind of stuff, this is where the insurance might be able to mitigate some of the risk of that cash flow. You have a possibility of injury, getting hurt. And then obviously you hear stories where people get cancer or get hurt, and the farms and neighbors are helping out, and they're helping them with their farm. You have labor availability. Some places are isolated, and maybe you have calving or something coming up, and all the high school kids are no longer available, or your local guys aren't there, and you're going to have a real struggle maybe getting through calving or that sort of thing. And so there's another risk that you face. Regulatory, rules and laws change, like the riparian things where you have rivers and things, and sometimes the grazing laws have changed for people, and they've had to change the way they do things. And that's a risk that you take whenever we're dealing with that sort of thing, and liability and legal issues. We have, of course, the common seasonal price variation. You're looking at the market in the early spring, perhaps it's really good. By the time fall comes around, it's not so good. So there's ways to mitigate that, and some of the insurance programs that we're talking about will cover some of that. And then, of course, there's droughts and catastrophes. And then, obviously, sometimes, you got cattle that are out there, and for whatever reason, they just don't do well this year, and your calf weights are down and your costs are up. And so there's a lot of production variation. And these are all risks that livestock producers face. And so as a result of that, the insurances we're going to talk about are going to help do that. So before we do that, but there are two kinds of very common risks that cattle producers face, and that we're going to talk about mostly today, and the insurances mostly address. And that is volatility in the markets, and then production risk, basically droughts and feed cost increases and shortages. So there's several insurances that work with, this pasture range management, or, PRF, and there's several other insurances. And then LRLP deals with the markets as far as soybeans and grain and different feedstuffs, help insure against margins, differences and changes. And then, of course, price in the volatility. These factors are particularly challenging enough for reduced profit margins. That's the thing is, you're looking forward to a good year, and then things happen and they're not so good. Or and sometimes it works the other way, which is kind of cool. Now, there's something that everybody's aware of, and there's a thing called the cattle cycle. And it's a real thing. The problem is it's not as predictable as it sounds. I mean, it's a cycle, but the cycle may not go up as much as people think it should, or it doesn't start exactly where people want it to. And so maybe they don't predict that well. So there's some risk associated with the cycles that occur in the cattle market as far as prices and those sorts of things. Plus, sometimes the grain markets get disconnected a little bit from the cattle markets, and cattle feeding and livestock production depends heavily on the grain markets, and there's a huge relationship there, and so that can affect cattle prices as well. Like, in other words, feeders, if you're a cow calf guy, may not be willing to pay as much for calves if grain prices are really high. Those kinds of things happen, and that's what these insurances are for, is to help protect against some of that. Now, this is just a picture, or no, well, not a picture, it's a drawing, a graphic that shows the average annual cattle calf prices in the Southern Plains, and you can see that there are the 500, the 700, and the fed steers. They all follow, or what we call co-integrated in economics, where these lines stay parallel nearly as they go up and down. Now, there are times that they may get closer and further apart, and for various reasons, and that can do with feed and some other things. But basically, they follow together. So the cattle seem to follow the similar cycles. But this gives you an idea how volatile prices may be. This is from 1996 to 2026. And you can see that, when we talked about the cattle cycle, okay, there's 2014, 2016, now 20. So what do you think is going to happen? Well, this is a peak, and we're probably at a situation where the prices are going to be up for a while. But as you know, as people get and can retain heifers and do certain things, this is going to eventually go back down probably. So you should be prepared for that, regardless of insurance or any ideas. But if you're a producer, you need to be thinking about those kinds of things. All right, there are a few key words in understanding your insurance salesman. You guys probably all know these words, but I'm going to review them quickly because I sometimes listen to salespeople or insurance people, and they just start rattling off terms, and they do it so fast that while you may know what it means, it's maybe it takes a minute or a second for you to, okay, that's what that means, and then by the time you thought of it, he's already on to something else, and you missed the conceptual idea of what he's trying to say or discuss with you when he's trying to sell you insurance, or when he's talking about some of the things associated with. And the common terms we're going to talk about today, there's not very many, just a few. We're going to talk about a premiums. We're going to talk about indemnities. We're going to talk about deductible. We're going to talk about liability and eligible cause of loss. Those are the primary things that, when we talk about insurance, that you really need to understand. And I'm sure that all of you understand it, but we're going to review it because I don't think you can review these terms too much, because if you don't deal with them every day, you only deal with them, once a year or a short time, you don't always get clarity, and it takes repetition and repetition and repetition for the human mind to be able to cope with it and to be able to make it easy to understand. So while you do understand it, it may be simpler. The more times you hear it, the more times you understand what it is. So a premium, if you want to think of it, is what your policy costs you. That's how I look at it anyway. And maybe, you could say what producers pay to obtain the insurance product after the premium subsidy is deducted. So in other words, there is a subsidy, like we talked about, the federal government, but this premium is basically, okay, that's what it costs me. I pay my insurance premium. You could always, some people may call it a bill. No, it is a bill. It costs you money. You have to pay for it. That happens at different times, different insurances, different times of year, different way you pay. But basically, it's money out of your pocket that you're going to have to pay to purchase this insurance product. A lot of times people call it a product. Premium subsidy, that's easy. That's the part paid by the federal government, USDA. The taxpayers subsidize so that your insurance is cheaper, so that you can basically afford it, and that production can continue, and that we can have a secure food supply. And those are the basic justifications that you hear for insurance products. Plus, we like to see our producers do well. Indemnity. I always find this to be a funny word. Indemnity sounds like something bad you did. Okay, you're going to jail. No, an indemnity then is just simply the payoff that you get when the insurance is triggered. So if the insurance is triggered, that means you're going to get an indemnity. That may be small or large. It doesn't have relative to the size, but an indemnity only occurs when the insurance gets triggered and you get something or some kind of payoff or buyback. In the case of cars, you don't get an indemnity till you wreck your car, or until they come out and say, oh yeah, we're going to replace this and this because of the accident or whatever happened. But that's what an indemnity is. It's pretty simple. A deductible. So we all know what deductibles are, because I think we work with other insurances and we know, okay, like, my car insurance, I have $1,000 deductible. That is the uncovered loss portion. So in many insurances, like in crop insurance, for example, you insure at a certain level. Like let's say you're sure at 50%. That means you would have a base yield, and at 50% of that production, you don't get any payment unless you go below that 50%. And so a lot of insurances are that way, and they have a product, so they only cover so much. They don't cover 100% generally. They only pay a certain amount. And that's when you get into what you got to think about is that, okay, there's two concepts in insurance that you need to understand, and that's efficacy and efficiency. Efficiency relates to okay, how well the system is working and how well it gets paid. Efficacy means, does it really solve the problem? So in other words, you can buy insurance and it's really efficient and it really pays, but it never pays enough to really do any good. That would be very not effectual. So it wouldn't have very good efficacy. So you think of efficacy as, is it really an effective in helping you insure the risk that we're talking about? And some insurances are better than that than others. And so, I mean, in some cases, insurance is going to help, but it's not going to cover the whole thing. So you got to remember that when you're buying insurance, you need to understand, how much does this insurance really give me back? What does it do for me? Does it ever pay off? Which is kind of, whether it's efficient. And the other one is does it really pay the amount that I need to cover the risk that I'm talking about? And if it doesn't, then you might consider some other measures that you might do to try to mitigate some of that risk. Or if you're taking that risk, to recognize the fact that it's not going to solve your problems, and be prepared in case something does happen. Okay, eligible cause of loss. This is a coverage trigger. Rainfall shortages, drought conditions would be eligible for certain kinds of, like, PRF or AF, which is we're going to talk about, which is types of insurances. Feed input cost changes. So these are like, okay, so, the grain inputs went up and you're feeding cattle and you've insured with, a different policy, does that create an indemnity? And so are you eligible for that? When that gets triggered, it's what caused that. According to the policy you buy, it'll tell you, okay, yeah, if this happens and the difference is this much, it's going to get triggered. And PRF is, well, okay, so you have a drought, it's going to be triggered. Cattle price declines. In other words, the difference between prices and cost of production. Some of these policies cover some of that, so that you can actually, oh yeah, so yeah, livestock prices, just the bottom fell out, and so now I have revenue protection or whatever I have that's going to help cover that loss, given the situation that I'm in. Okay, so now those are the three keywords that we really talked about. Now let's talk about 4 very simple available livestock insurances that are primarily what we want to talk about. We're going to talk a little bit about LRP, which is livestock risk protection. We're going to talk about a new one. This is an interesting insurance. It's called Wean calf risk protection. It's WCRP. Okay, it's like, okay, and then there's pasture rainfall forage, which is PRF, that's the one where, and you have each one of these for different reasons, because they cover different things. And then you have the annual forage policy. Now, each one of these has a different reason for existing in a different purpose. And so if you understand the purpose, then you can say, you know what, this doesn't really fit my operation or what I'm doing, so I don't need to worry about this. Or this really fits what I'm doing. Or maybe, let's say you decide to feed cattle or do something, maybe the LRP might be something you're going to consider more than that. If you don't have wean calves and you wean calves, or you grow calves and have cow calves, the wean calf risk protection is, why would you even think about it? Now, what's interesting is we're going to talk about 2 parts of this. We're going to talk about, this is a situation you might want to think about this insurance, and then we're going to talk about some of the things associated with the insurance, not in detail, because that's what's the part 2 is going to talk about, We're going to talk about the nuts and bolts of some of these insurances and talk about, okay, this is how they work. This is a scenario. And in this scenario, this is how much it would pay off. I really think, the one thing sometimes in insurance, and if you're not as familiar with it and haven't been through the process, maybe you don't always understand, okay, I'm insured. Yay, great. But what does that really mean? How does that really triggered? And so I know on paper how it's triggered, but what does that really end up for me when I've paid for the insurance, I have the problem, and now what kind of actual financial situation am I now in as a result of having the insurance or not having the insurance, and what does that do for me? And then you can evaluate, okay, how risky is this situation and what's it about? And that's really what with insurance, regardless of whether you listen to us or don't listen to us, one thing you need to understand is you need to understand exactly the process by which you are being insured. You understand, okay, these are the things that happen with insurance. This is the process. I bought this insurance. I bought it at this level. I've triggered it at these points. This is what's going to happen, and understand exactly what that is so that when a situation arises and you recognize that it's occurred, you're able to understand what to expect. And then you can talk to your insurance person, legitimately in a way that would help you, that conversation be positive, and that way you also recognize that what you're getting is going the way it should, or maybe there's some problem that you want to address. And those are the things that you need to understand. And that's why it's important to understand insurance, because it's kind of like the bank account thing. There's people I know that don't balance their checkbook and don't know how much money they have in the bank. They just depend on the bank to keep track. Well, I've had situations where the bank has been off by quite a bit. And that would cost me money if I didn't address it and say, hey, wait a minute, what happened to this money that, I say I have this much, here's all the transactions, and you say I have that much, what went wrong? And that's very helpful. And it's very important. It's kind of like being responsible for your own health care. You don't go into the doctor says, well, we're going to amputate your leg. You go to the doctor, okay, you can amputate my leg, but why? And what are the repercussions, and are there other alternatives? That's kind of how you should do it, because there's nobody as concerned about your health care as you are, and there's nobody concerned about your operation as you are. I mean, you may have people that are experts and can help you, and they're real sincerely trying to, but you need to understand these things so that you can make better decisions about whether you want to take the risk or not take the risk, or move forward with some kind of insurance product. And that's the whole point of insurance. And recognizing that in the insurance business, insurance people, while they're good people, don't provide insurance because it's fun. They provide insurance because they make money on it. And fortunately for us in agriculture, the government's paying part of the bill, and that depends on the insurance and what they're doing. But that doesn't always mean that it's the right deal for you, nor does it work for you, nor does it mean that maybe you're missing out on something you should be taking advantage of. But you should always remember there's probably no such thing as a free lunch. Okay, and that's just the way I always look at it. And I'm sure you probably already all know all this stuff, but I just reiterating, I'm not telling you anything that you don't know. Okay, what does livestock risk protection cover? It protects against a drop in market price. Producers' price don't affect the indemnity. In other words, what you actually get in the market, which you may have a contract or you may have sales some other way, doesn't affect the indemnity. The indemnity is based on some general formulas and general concepts and general identified prices and things that are triggered, and you need to understand what those are. You must have full ownership of the livestock. That means if you don't own them, you can't really insure them. You must list state and county where the cattle are located. Once insured within a state, the livestock may be moved across state lines. So you have some flexibility there. Those are things that that are conditions of the LRP generally. You need to know in detail what they are. These are just some of them. So if sometimes if you think, well, I'm covered, and maybe you're not in those conditions, you think you may be covered, maybe you're not covered quite the way you are. Facts and other conditions about LRP. You're not required to insure all your livestock. In other words, you can not do some. This is not true for some of the policies. In fact, we're going to talk about that in a minute. This is a subsidized insurance program, as I said. So that means you're not paying the full premium cost. The insurance companies are getting money from the government as well. So depending on what you buy, They get a certain amount depending on the particular policy and what it goes about. Premiums are due at the end of the insurance period. That means you don't pay up front, you pay after the fact, which makes sense because after the cattle are sold, some of the proceeds of the cattle basically pay for the insurance. Uses area pricing to determine if an indemnity is due. So like I said, it's not what you did, it's a localized area to a specific area to a point. Allows coverage on a wide variety of livestock, including unborn cattle, which that makes sense. I'm not sure people use it for that, but that there's a wide range of that. So you want to understand that fully and understand how that works, so that you can, if you have a situation where you want to insure and do that you would do that. Ability to market livestock up to 60 days prior to the end of the insurance period, which is kind of good because then you if you see an opportunity in the market and that comes along, your cattle ready, you can do something about it without violating any of the policy rules and etc. All right, and there are other rules and stuff, and you can get into the details, and you need to talk to insurance people. The idea here is to give you some general ideas about things that you might be considering. All right, so wean calf risk protection. This is a brand new product. This product is in Nebraska, actually, and it's it's an interesting product because it also has revenue protection. So there are price things that it can cover as well. But basically, you're basically saying, okay, I have so many calves. I want to insure my calves. Now, the calves have to be born, have to be accounted for. And if you have to have 100% of them, you can't just insure some. Okay, so which is kind of an interesting deal. So in other words, if you got 150 calves and they're all born, you can insure them. Now, if you got 175 cows that are pregnant and you only get 150 calves, then you can only insure the 150. So at least that's my understanding of the policy. This is a brand new policy. You might want to understand it more in detail. You might want to talk to an insurance person about it. But basically, it's a situation where if you feel like you might have some losses or the prices might go down or some things might happen and you want to lock in that, you're going to look at this insurance carefully, try to figure out, hey, does this work for me? Are these prices right? Is this what I want? Now, it only covers beef animals, but there's a caveat. What is a beef animal? Now, for example, if you have Corians, and then you got like or rodeo cattle that don't, or Mexican steers, whatever you have, that are going to be small framed and small and grow slow, you can't really use this. It only works for like cattle that are beef production animals. So there's some little details in there you might want to look into. The other thing is if you're a dairyman and you got Angus bull out there with all your heifers and all those calves are crossbred, you can use this product because what else are you going to use those animals for? Their beef, and they're going to be large frame and they're going to have enough muscle on them to qualify for the particular insurance product. So that's true too. So not that there's a lot of dairies in Nebraska, but if you had dairy cows and did that, you could do that. You all calves, both sexes. In other words, okay, so well, I'm only going to insure the steer calves because those are the ones I'm selling, or heifer calves, whatever. You depends on what you. But if you're going to retain heifers, they still get insured, and it doesn't mean you have to sell them. It just means that you insure them. Okay, so there's some things there that you need to look into and understand if you use this insurance. And I already said things about the crossbred. Now, it's a once a year sign up, and it's only for spring calves at this point. So in other words, if you're a fall calver, this isn't going to work because you have to sign up in January, and it's for spring calves. So I think January 31st was this last year's deadline. Like I said, this is a pilot program. This is new. It's going to be a situation where, I don't know. There's probably kinks in it. There's probably things you want to look at. But if you really feel like there's a risk, like let's say you got a situation where you get your calves all done and the things, and you're in a winter situation where maybe you've had winter storms and lost quite a few calves in the past, this may be something to consider. Or if you've got a lot of dangerous things on your property, which I have no idea what that would be. Calves are falling off cliffs or whatever. I don't know. You may, and you have a high risk or you have a high predatory count, predation issues, these are things that you might sign up for or think about. It ends at weaning. So in other words, once they're weaned, they're no longer insured. So that's the end date. I mean, you can sell your calves, pre-contract them and do a bunch of stuff, but the insurance actually ends at weaning. So that's something to consider and understand what that really means and what the repercussions of that are. Okay, I already told you about this. It's against death loss, basically. So if you have problems or you think you might have issues and challenges on your operation because you have a higher death loss than you think is good, I mean, maybe you got some problems in a pasture and you're trying to clear it up, but you have a higher death loss because of bacteria or some kind of infestation or whatever. And calves, unfortunately, and that are born in this particular, you have historically had problems keeping a high, and you have death count. That might be something to consider. All right, pasture rainfall insurance. This is the standard PRF. Basically, what this is this is you got to choose a lot of things in this particular type of insurance, meaning you choose the coverage level, you choose how much you're going to get, you choose when it's going to occur, and and specific things, because basically it depends on it's a rainfall issue. In other words, it doesn't even measure how much pasture you end up getting or how much range you insure a range and you insure a thing, and it's a certain value, it's a certain amount of forage production, whatever, and you set a certain time period. And what they do is they look at these rainfall grids and say, oh, it didn't rain there, so guess what? We're going to give you money. Or it did rain there, and so we're not going to give you money. But yet maybe you didn't get a lot of forage out of it because your neighbor got all the rain and you didn't, because these grids are like 17-mile squares, and they're from NASA or NOAA, sorry, which is part of NASA, and they calculate rainfall. So it's a rainfall index, and then they pay off according to that. From my observation, and I could be mistaken, but from my observation, these things pay, but they don't always pay tons and tons of money. They will cover part of the forage loss when they do pay, but they don't necessarily do tons and tons. So I'm not sure that how expensive they are, but I think that they can be a good thing if you really think that you're going to have a problem in droughts or whatever, and you can do that. So you need to investigate that more fully, the PRF. Now, a similar type of insurance is a thing called, this is forage loss, like I said, which is part of production cost. And that's basically what you're using it for, is to cover production costs given the forage loss. But think about this, if you really do have a drought, and if it's a widespread drought, they may pay you, but forage may be more expensive than normal. So this is only one tool in the tool you might use to use against drought, because there are other tools. I mean, there are people that basically have the opportunity that they graze both yearlings and they graze both cow calf. And then when they figure it's dry, or they see looking at dry conditions, they may not graze the yearlings, and that's a strategy. There's other people that harvest hay and store hay for multiple years, and they keep a stock of hay on hand so that they have enough to go through a season if there's forage that is short. That's another way of insuring. But the PRF then is when you're actually going to get some dollars when rainfall is short in a particular grid on a map. So you may actually end up with forage and still get paid, or you may end up with not a lot of forage and not get paid, depending on how the map works out relative to what's used. So it's not bad, it's not good. It's just be aware of the situation that you're getting yourself into. All right, so the annual forage insurance, this one is interesting. It's very similar to the previous one, similar works, but it's for annually planted forages. So like there are people that graze wheat, obviously, winter wheat, that this would work for them. There are people that have a pasture and plant it. They may plant oats, or they may plant, maybe they have a meadow or something they're going to plant or do something with for a year or so. Anyway, this is a similar type of insurance, and it's basically for forage, and it's for annually produced forage. Now, there's some interesting things about this insurance. is that you can, like in the case of winter wheat, you can insure both for the forage production, the grazing, but you can also insure for small grain yields, like in a grain program. So there's some things that if you're doing some of that and have some winter wheat or do something like that, you may want to look into this and see how this works and how it works for you or it doesn't work for you. It's basically, again, a similar thing. It's basically all about dryland farming or dryland grazing, and it has to do with precipitation and kind of insure against that. All right, so those are the four insurances. These are the LRP, the WCRAP, no A, just P, and the PRF and the AF. And these are all insurances, and they're all available. Look, the whole point of insurance is so that the risk can be borne by someone else and you pay for that. And this is how insurance works. Insurance can be a good deal or a bad deal. It's always a good deal when you get indemnities that pay for the insurance and help cover your loss. It's always not a good deal if, oh, it didn't indemnify and it didn't really do anything and you didn't have a problem. But at the same time, that's why you have to evaluate what the risk is and decide, does this insurance really mitigate the risk? And if what I'm paying for it really worth what I'm getting back? I have experienced a little bit with multi-peril crop insurance, which is a little different. And one of the things that I note is that multi-peril crop insurance has some interesting caveats, if you will. Multi-peril crop insurance, a lot of people insure at a low level. They'll insure at 50, 60, 70%, which is fine, except for what you find is it's cheaper, yeah, but even if you collect, you're not going to recover your losses because your production cost maybe requires an 80% crop. So basically, you're still going to have a 10% loss. So the question I think sometimes you have to ask yourself is, if I'm going to insure, at what level am I going to insure? And how much am I going to insure? And if I'm going to insure, I want to make it, I'm going to make sure that if there is a problem, I get an indemnity. And yeah, it's more expensive, maybe a little bit. But then what happens is now I've got some help with what I'm trying to insure. Now, that may not be the case, and you may not, oh, no, this is stupid. This costs a lot of money. And the chances of me ever having that happen is so low that it's not worth it. And that's a decision that each individual has to make. But that point is, insurances can be good if you understand the risk that you're facing and you understand how the insurance works and helps you mitigate that risk. And that's the key thing. And that's what I tell anybody. If you're going to get insurance, make sure you understand what you're insuring, why you're insuring it, and the risk associated with it as best as you can, and grab a hold of that. And with multi-crop peril crop insurance, that's kind of been the case from my observation. And these insurances are very, very similar. And like I said, some insurances pay a lot, some insurances pay a little, and some insurances, they pay you something and then you have them, but then maybe they don't cost as much. So that's what you got to look at. You got to evaluate, you got to know. And it's unfortunately takes time to do that and to understand. But the more you understand about it, the more you can make a better decision and and spend your money wisely on mitigating risk. And that's basically what we have for today. Here's the contact information, farm aid and the suicide thing and the rural response and all those kinds of things that we want you to have if you want that information. Are there any questions?
Thank you, Matt. We don't have any questions yet. One just came in, a couple just came in actually, as I said that. So we'll get to those in a moment. If you do have questions, please type them into the Q&A panel. We have some time left in the hour, so Matt will do his best to answer those. And if you do close out of your Zoom window, there'll be a very short survey that will pop up. If you don't mind, please just providing some quick feedback on the webinar. It really helps inform our series here at the Center for Ag Profitability as far as future webinars, and tells us how today went. And a reminder, part 2 next week in this series, we'll be back with more on livestock insurance, May 29th, same time from noon to 1 Central. And I put that link to register in the chat. Okay, Matt. So first question um, is about captive insurance. If you're familiar with captive insurance, so Corey Walters here with the Center for Ag Profitability, he's talked about captive insurance. We had a webinar several months ago with two producers who were using captive insurance on their operation. Did talk about it more on the crop side. Are you familiar enough with captive insurance to know?
No, I'm not gonna claim that I know enough to give anybody any advice. What was the question though? Just what was the question
Just
about?
wondering if anyone is using it for livestock, and just asking how that would be structured. I know during that webinar, I remember Corey, I think, did mention that it's in use for livestock operate or available to use for livestock operations. If that's not something you're aware of, Matt, we can
Well,
definitely.
what I would recommend is that if you want to know more, and Corey is an expert in insurance, and that's what he studies and researches. I study farm management and I have general knowledge, and I'm not going to, pretend that I know something I don't just because I have some PhD in front of my name. So what I think you should do is, if you want that information and you have give us contact information, and Ryan, we can give him the Corey Walters contact information, and I would contact him and talk to him, because if he doesn't know, which I doubt, he probably does, and he does know a lot about captive insurance, that sort of thing, he can then direct you to someone and you can get the answers that you need, because we want you to have the answers that you want. And I'm not about to try and give them to you because I just confuse the issue, I think.
Perfect. Yeah, thank you. So I did let them know to reach out to Corey, or happy to take their info too and have Corey get in touch. Next,
Absolutely.
next question was about wean calf risk protection. The question asks if there is a typical loss percentage where it would become useful. For example, if someone averages a 15% death loss on a 100 head herd.
Well, okay, so now my understanding of the insurance, which is new, it has also got a revenue protection device. So I would imagine that there's two things going on. It's a death loss coverage. So, you're saying, how many calves do I have to lose before it pays for itself? Well, that depends on the value of the calves. So if prices are really high, I would think that it might affect the premiums a little bit, but you're going to probably say, if I lose X amount of calves, you can say, it's not, if I'm really worried about that and prices are really good and the insurance is pretty reasonable, I'd say, yeah, well, okay, I'm an insurer. But let's say that, we're in the Great Depression and you're knocking your calves in the head because you can't afford to feed them, then I would say, no, you don't really want to buy insurance. So it depends on, like I said, it depends on the value of the calves, the revenue, and the cost of the policy, and that's going to vary. And because this is new, you're going to want to really look at that closely and try to make that decision. But we don't have any research that says, yeah, when you're at less than, if you have 5% death loss, you should insure. But I'm guessing it's going to be, because a loss of a calf in this day and age, if you got $3 a pound and it's 500 pounds, I mean, that's $1,500. And I don't think it's going to cost that much to insure them. So you're really going to have to think about, okay, what's the probability of loss and how that loss and what's that level? So, how much risk you want to bear, and it's going to depend on the price, not just the number of calves.
Great. Thanks, Matt. Reminder, if you do have a question, please type that into the Q&A. Next one that just came in, Matt. LRP doesn't go very far out to protect the value of calves, so how can one insure for a price drop?
Okay, well, this is where you may want to talk to somebody in marketing, because there are ways with puts and calls and various tools to assure price stability. And it's I'm not going to give you advice on that because I'm not a marketing expert, but I do know how it works, relatively speaking. I mean, there's puts and calls, and then and I know that a lot of people, well, you have to understand though what you're doing and how in the money, out of the money, and what the prices are and what you and what and so you would want to talk to somebody that knows how to do that and to work with them and be able to understand it. But that can help assure price floors. You can actually lock in some price floors and do some things. Now, that's not always cheap, but again, if you're really worried about prices going down, you're going to want to do something. In other words, in a year where you're beginning to see inventories climb and you're beginning to see a downward trend in the market and there's pretty good prices in the spring, and you want to lock in prices for weaned calves, you're going to want to do something. You're not going to want to just sit there. And there is, like I said, I think and I don't understand it completely because I haven't really torn it apart completely yet, is this weaned calf thing where you can take and guarantee a certain revenue protection. Okay, so in other words, that would go for price and death loss, a combination of both, if it works anything like the other programs, which I think we're going to talk about that more next time. And I'm not as familiar with it as I'd like to be because it's brand new.
Might point out, I just put it in the chat, but Elliot Dennis is an associate professor at
Awesome.
Center for Ag Profitability in the Ag Econ department here at UNL. He is our resident livestock marketing expert and would probably be able to answer questions about this if you want to follow up with him. I put that link in the chat box to find contact info for Elliot.
Right, because options and those kinds of things are actually designed to, they work like insurance in a sense. Okay. But you're going to want to understand how that works and what you're doing.
Perfect.
And I'm not going to explain it over the right now. And I'm not sure that I can explain it in a way that would be helpful.
Very well. Thank you, Matt. Next question says that all these insurance products have a cost. If one uses them, does that reduce profit of the operation?
Okay, so that's an interesting question. I think all these are all good questions. Oh my gosh, you guys are concerned, and you should be. Okay, so what you're saying is, it costs money to buy insurance. Yes, it does. But it costs money to lose money when you have risk. So the decision, which is a difficult decision, as you're talking about, how much money do I want to spend on insurance to mitigate what I fear is going to happen or the risk that I'm taking? And that's a personal decision that people have to make based on how much they think their business can handle if there's a bad situation. So yes, it's going to eat into the amount of revenue that you're going to have total at the end. But if you have a situation where things go bad, you're going to have a lot less revenue and it's going to add to your revenue. So it can add to your revenue or take away from your revenue depending on the actual circumstances of what happened. And so when you're buying insurance, you're basically buying it in the future and saying, is this going to happen or not happen? Am I willing to take the chance or not take the chance? And that's what risk is all about. And so there are some risks that are big enough and large enough and devastating enough that you say, you know what, it's not worth the risk. Yeah, it costs me money, but I'm paying so that I will still be in business at the end of all this. I mean, insurance is not, a guarantee for profitability. That's not what insurance does. Insurance basically says if you have risk, if you have situations, and you believe things are going to happen, and you don't want that to happen, you're going to pay some money to take that and mitigate that somewhere else. So that's what you have to decide is if there's not enough profit in it to have the risk, and you say, well, I'm going to go bankrupt anyway, well, then insurance doesn't do you much good because then if it doesn't happen, you didn't spend the money and you have the extra profit. But if it does happen and you don't want to be out of business and you go out of business because you took too big of a risk, that's not wise either. So that's a balancing act. And that's why an insurance is not a guarantee, but it's a way to mitigate some of the concerns that you have for your business. And every business manager has to make the decisions. Okay, what am I willing to accept and what am I not willing to accept? And that's why it's important to understand the risk, how big a risk you're really taking, and to understand what does this insurance really do for me? Is it worth the dollars that I'm paying for it? And that's evaluated on an individual basis. And that's why you need to adjust the level of your insurance as well as the type of insurance.
Great. Thank you, Matt. That was the last question for now that I see, but if you have one lingering in your mind, please do type that in the Q&A panel now. Just remind people that as you close out today, you'll see a very brief survey asking about what you learned and what other topics are on your mind. If you could just take a moment to complete that, it really helps inform our webinar series here at the Center for Ag Profitability. And one more reminder that you can find this recording soon, and you can also register for part 2 of this webinar next week at cap.unl.edu/webinars.
Okay, I would like to say thank you for participating today. Those of you that participate, and those of you who see this web later, great. I hope that it provides some value, because what's the most important thing is it's your business. It's your operation. You really want to be successful. We would love to see that happen. And if there's something we can do to help give you information or do that, that's what our extension is all about. So thank you very much for just being concerned about your business, being concerned about insurance, and I appreciate that.
And thank you, Matt, for stepping in today to cover this whole presentation. And again, thanks to Shannon Sand, who put it together. She couldn't be here today to present. I believe she will be back next week for part 2 is the plan. But again, as Matt said, thank you very much for attending today. And seeing no more questions, I think we can call this webinar right now, Matt. So thanks again.
Thank you very much. Then
Everybody.
goodbye, everybody. Have a nice day.
Yep. Have a great afternoon. Thanks again.
Absolutely.